December 23rd, 2025, 11:47 p.m. Eastern Time. While you're watching this video, a silent shift is taking place in the global financial system. Not with alarms, not with emergency headlines, but with price signals that most people are trained to ignore. Silver has just closed above $71 per ounce in Shanghai. That number alone may not sound shocking at first. Prices move every day, markets fluctuate. Analysts adjust their forecasts. But the shock is not the number itself. The shock is where that number exists and where it does not. At the exact same moment, silver closed above $71 in Shanghai. It was trading several dollars cheaper in New York. Same metal, same chemical composition, same industrial utility, same global supply, yet two different prices. For decades, this situation would have been impossible to sustain. Not unlikely. Impossible. Because global markets are not held together by trust or fairness. They are held together by incentives. And when incentives exist, capital moves without hesitation. Buy cheap in one market, sell expensive in another. Capture the spread. This process is known as arbitrage, and it is the backbone of global price alignment. It does not rely on belief. It does not rely on narratives. It relies on math. Cold, mechanical math. If silver trades cheaper in New York than in Shanghai, traders buy in New York, take delivery, move the metal, and sell it in Shanghai. This continues until the price difference disappears. That is how markets are supposed to work. That is how markets have worked for generations. Except now, they aren't. Because the price gap is not shrinking. It is expanding. Week after week, the premium in Shanghai has remained stubbornly elevated. What began as a small divergence has hardened into a structural separation. A separation that refuses to be arbitraged away. And that raises a question that few are willing to ask openly. Why isn't the money moving? Because if silver were truly available in the West at these prices, the trade of a lifetime would already be underway. Billions of dollars would be rushing to exploit the gap. Ships would be booked. Inventories would be drained. Prices would snap back into alignment. But none of that is happening. The capital that should be flooding in is missing. The trade that should be automatic is absent. And the only reason arbitrage ever fails is when the underlying assumption fails. That assumption is delivery. Arbitrage only works if metal can be delivered. Not promised, not deferred, not settled in cash, delivered. And this is where the story changes. Silver is not just another commodity. It is woven into the fabric of the modern world. Solar panels cannot function without it. Electric vehicles depend on it. Advanced weapon systems require it. Data centers, AI processors, medical devices, all of them consume silver. Unlike gold, silver is consumed. Once it is used, much of it is gone forever, scattered in tiny amounts across billions of devices. For years, supply kept pace because demand was predictable. Mines produced enough. Recycling filled the gaps. Inventories acted as buffers. But demand is no longer predictable. The global energy transition alone has rewritten the silver equation. Solar capacity has exploded. Each panel requires silver paste. Multiply that by millions of panels, then billions, and suddenly a market that once had surplus finds itself tight. At the same time, geopolitical realities have shifted priorities. Strategic materials are no longer treated as mere inputs. They are treated as leverage. And nowhere is this understood more clearly than in Asia. China does not view silver as a trade. It views silver as infrastructure. When China buys silver, it is not chasing price appreciation. It is securing supply chains. It is insulating itself from external shocks. It is ensuring that future production lines do not stop because a Western exchange cannot deliver metal that exists only on paper. This difference in philosophy is critical because markets price assets based on how they are used, and silver is no longer being used the same way everywhere. Western markets still treat silver primarily as a financial instrument. Futures contracts, options, leverage, speculation, price exposure without ownership. Eastern markets treat silver as a physical necessity. The difference is now showing up in the price. Shanghai is paying a premium because Shanghai wants metal. New York is discounting silver because New York is selling paper. Those two realities can coexist only for so long. To understand how serious this is, consider how tightly aligned prices used to be. For years, the difference between silver prices in Shanghai and New York rarely exceeded $1 or $2. That small spread reflected shipping costs, insurance, financing, and China's value-added tax. Any deviation beyond that was quickly erased. Traders lived for these moments. Arbitrage desks were built to exploit them. Algorithms scanned markets in real time, executing trades within seconds. The system was efficient, relentless, unforgiving, which is why the current situation is so alarming. Because efficiency has vanished. The spread is no longer behaving like a temporary imbalance. It is behaving like a permanent scar. And scars form only after damage. When Shanghai closed above $71 per ounce and COMEX lagged several dollars behind, the implied message was unmistakable. Physical silver is worth more than paper silver. not in theory, in practice, and markets are beginning to act accordingly. This is not the first time in history that paper markets have diverged from physical reality, but every time it has happened, the resolution followed the same pattern. First, denial. Analysts insist the divergence is temporary. Commentators downplay the significance. Official statements reassure participants that inventories are sufficient. Then, strain. Delivery times lengthen. Rules are adjusted. Cash settlement becomes more common. Transparency decreases. Finally, repricing. Prices leap to where the physical market has been all along. By the time this final stage arrives, participation is no longer optional. Those who relied on paper exposure discover that exposure is not ownership, and ownership is everything. Right now, the silver market is somewhere between denial and strain. The warning signs are visible to anyone willing to look. Inventories on Western exchanges have been trending lower for years. The amount of registered silver, metal explicitly available for delivery, is a fraction of total open interest. In simple terms, there are far more claims on silver than silver itself. This imbalance is manageable only if most participants never demand the metal. But what happens when demand shifts? What happens when industrial users, sovereign buyers, and strategic planners decide they no longer trust promises? They do what Shanghai is doing. They bid for metal, and they pay whatever it takes. The failure of arbitrage is not a market anomaly. It is a message. It says that the system designed to balance prices no longer trusts its own foundations. And when trust disappears from financial plumbing, outcomes become nonlinear. The real stress in any commodity market never begins with price. It begins with delivery. Price can be argued with, explained away, rationalized. Delivery cannot. Either the metal shows up or it doesn't. And this is where the Western silver market begins to reveal its weakest point. On paper, COMEX silver looks abundant. Warehouse reports list tens of millions of ounces. Headlines repeat these figures as proof that there is no shortage. Commentators point to inventory charts and declare the situation under control. But paper totals hide an inconvenient distinction. Not all silver in a warehouse is the same. There is eligible silver, metal that meets exchange specifications, but is owned by someone who has not made it available for delivery. And then there is registered silver, metal that is explicitly committed to satisfy futures contracts. Registered silver is the supply that matters, and that supply has been shrinking year after year, while open interest, the number of outstanding paper claims, remains high. This imbalance is not new. What is new is the growing reluctance of metal holders to convert eligible silver into registered silver, because doing so means one thing: letting it go. And in a world where physical silver is becoming strategically important, letting it go at suppressed prices makes less and less sense. This is why arbitrage capital hesitates. To arbitrage the Shanghai premium, a trader must buy a futures contract in New York, stand for delivery, receive the metal, transport it, and sell it in China. That trade only works if each step is guaranteed. But what happens if delivery is delayed? What happens if settlement is offered in cash instead of metal? What happens if rules change midstream? Those risks transform a risk-free arbitrage into a gamble. And professional arbitrageurs do not gamble. They step aside, which is exactly what we are seeing. The absence of arbitrage is not due to lack of profit. The profit is obvious. It is due to lack of certainty. Meanwhile, Shanghai operates under a different philosophy. Contracts there are backed by physical settlement expectations. Delivery is not an edge case. It is the point. Participants enter the market knowing that metal will change hands. This attracts a different type of buyer, not leveraged speculators, but users, manufacturers, infrastructure planners, state-linked entities. They are not price-sensitive in the way traders are. They are supply-sensitive. If the metal is needed, the price is secondary. That is why Shanghai bids rise, not because of hype, but because of necessity. This creates a feedback loop. As Shanghai prices rise, they signal scarcity. As scarcity becomes visible, holders of physical metal become even less willing to sell. As supply tightens further, prices rise again. In a normal market, arbitrage would break this loop. Metal would flow from surplus to deficit. But when surplus is illusory, when it exists only on paper, the loop intensifies. This is where Western narratives begin to fracture. Because the story that silver is plentiful relies on the assumption that paper supply equals physical supply. It doesn't. Paper supply is infinite. Physical supply is not. Every new futures contract can be created with a keystroke. Every ounce of silver must be mined, refined, transported, and stored. These two realities are now colliding. And Shanghai is the pressure point. Historically, moments like this do not resolve quietly. They resolve when one side capitulates. Either physical prices fall, meaning demand collapses, or paper prices rise, meaning suppression fails. Given current industrial demand, collapse seems unlikely. Solar deployment is accelerating, not slowing. Electrification is expanding, not retreating. Military and technological demand is increasing, not shrinking. Silver is embedded deeper into the modern economy than at any time in history. This is not a cyclical shortage. It is a structural one. When structural shortages meet financialized pricing systems, the result is always the same. The financial layer breaks. We have seen this before. In energy markets, when physical supply constraints overrode futures pricing. In base metals, when inventories vanished overnight. In currencies, when pegs failed after prolonged denial. The pattern never changes. First, divergence. Then, disbelief. Then, disorder. And finally, repricing. The most dangerous phase is disbelief, because that is when exposure accumulates. Investors remain overleveraged. Institutions assume continuity. Risk models extrapolate the past. But the past is no longer a reliable guide, because silver's role has changed. It is no longer just an asset. It is an input. And inputs do not behave like investments. They behave like bottlenecks. This is why the phrase structural premium matters. A temporary premium suggests inefficiency. A structural premium suggests something far more serious. A permanent change in how the market values access. Shanghai is not paying extra for silver. It is paying extra for certainty. Certainty of delivery, certainty of availability, certainty that production lines will not stop. That certainty now carries a price, and that price is being discovered in the East. Western markets, by contrast, continue to price silver as if availability is guaranteed, as if inventories are elastic, as if delivery is optional. That assumption worked when silver demand was marginal. It does not work when silver becomes critical. The longer this divergence persists, the more violent the resolution becomes, because suppressed prices encourage consumption. Low prices stimulate demand. High demand drains supply, which makes suppression even harder to maintain. This is the trap paper markets fall into. They delay adjustment until adjustment becomes unavoidable. At some point, a choice must be made. Either prices rise to ration demand, or demand overwhelms supply. There is no third path. This is why sudden repricing events feel shocking. They are not sudden. They are delayed. The pressure builds invisibly until the system can no longer contain it. Shanghai's premium is that pressure made visible, a crack in the facade, a signal that the physical market has already moved on. Those watching closely understand this. They're not asking whether silver will reprice. They're asking when, and more importantly, where. Because the market that sets the price is the market that controls the metal, and control is shifting. This is not about East versus West. It is about reality versus representation, and reality always wins. When markets reach this stage, the final phase does not begin with panic. It begins with subtle adjustments. Rules are reinterpreted. Definitions are stretched. Language becomes deliberately vague. Exchanges do not announce failure. They manage perception. This is the most misunderstood aspect of market breakdowns. People imagine a dramatic halt, flashing warnings, and emergency closures. In reality, breakdowns are bureaucratic. They happen through footnotes, policy updates, and temporary measures that quietly redefine obligations. And silver is approaching that moment. If delivery stress continues to intensify, exchanges have a limited set of tools available to them. The first is delay. Delivery windows can be extended. Settlement timelines can be pushed back under the justification of logistics, verification, or extraordinary demand. On paper, nothing fails. In practice, metal does not arrive on time. The second is substitution. Cash settlement is presented as an equivalent alternative. Participants are offered fiat compensation instead of physical silver. The contract is honored, technically, but the promise of metal is replaced with money. The third is rule modification. Position limits are adjusted, margin requirements are raised, new categories of settlement eligibility are introduced. Each change reduces pressure while maintaining the appearance of continuity. None of these actions are unprecedented. All of them have been used before. And all of them share the same consequence. They signal that physical supply is no longer sufficient to support the paper structure built on top of it. The moment cash settlement becomes normalized, the market has effectively admitted that paper silver and physical silver are not the same asset. That distinction changes everything, because price discovery can only occur where settlement is physical. A market that settles in cash does not discover the price of silver. It discovers the price of exposure. And exposure is not scarcity-based. Metal is. This is why Shanghai matters so much. Shanghai is not negotiating exposure. It is negotiating metal. Every contract that settles there tightens the physical market further. Every ounce delivered into long-term industrial use disappears from circulation. This creates a ratchet effect. Supply tightens, premiums rise, holders hoard, liquidity dries up, and the paper market becomes increasingly detached from reality. At this stage, Western market participants face a dilemma. If they continue to sell paper silver at suppressed prices, they accelerate physical drain. If they raise prices, they validate the Eastern premium and risk losing control of the narrative. Either choice weakens the system. This is why final phases often last longer than expected. Institutions delay decisions until delay itself becomes costly. Meanwhile, something else begins to happen quietly. Long-term contracts are renegotiated. Industrial buyers who once relied on spot markets begin seeking direct supply agreements. They bypass exchanges entirely. They pay premiums for guaranteed delivery years in advance. This removes even more metal from visible markets. What remains is a shrinking pool of liquidity supporting a growing mountain of paper claims. The ratio becomes unstable. This is the point at which volatility changes character. Price moves are no longer smooth. They become discontinuous. Gaps appear. Limits are hit. Liquidity vanishes at critical moments. These are not signs of speculation. They are signs of exhaustion. Historically, this is when the public narrative flips. What was dismissed as temporary dislocation becomes unexpected supply constraints. What was called regional pricing becomes structural imbalance. Language evolves because denial can no longer be maintained. But by the time the narrative changes, positioning is already complete. Those who needed metal have secured it. Those who relied on paper discover that paper is abundant. Metal is not. The repricing, when it comes, rarely unfolds linearly. It happens through cascades. One failure triggers another. A missed delivery leads to a policy response. That response triggers a loss of confidence. That loss of confidence causes participants to rush for exits simultaneously. Markets built on leverage cannot absorb synchronized exits. Prices jump not because of buying enthusiasm, but because of selling absence. No one is willing to sell real metal at old prices, so prices move until someone does. This is how suppressed assets reprice. Not gradually, suddenly. At that point, historical comparisons flood the media. Analysts point to past crises. Commentators search for explanations. Regulators promise reviews. But explanations do not reverse repricing. Once the physical market asserts control, it does not give it back. The most important misunderstanding about repricing events is the belief that they overshoot and then revert. Sometimes they do, often they don't. When repricing reflects a structural change rather than a speculative spike, the new level becomes the baseline. Silver's role in the global economy has changed. It is more embedded, more demanded, more strategic. The price structure that existed when silver was abundant cannot survive in a world where silver is constrained. This is why $73 in Shanghai matters. Not as a number, as a signal. It tells you where silver clears when physical demand dominates. It tells you what price emerges when delivery is non-negotiable. It tells you that the market has already moved, even if headlines haven't. Western prices will not remain immune. They cannot. Either they rise to match reality or they lose relevance entirely. And markets that lose relevance do not set prices. They follow them. At some point, global participants will stop asking where silver is cheapest. They will ask where silver is available. That shift changes the entire pricing mechanism. Availability becomes the premium. Trust becomes the currency. This is the final phase. Not collapse in the dramatic sense, but transition. From paper dominance to physical authority, from financial abstraction to material constraint, from promises to possession. Those who understand this phase do not wait for confirmation. They recognize the pattern. They see the signals. They act before consensus forms. Because consensus always arrives last. Shanghai is not predicting the future of silver. It is revealing the present. The rest of the world simply hasn't caught up yet.